The scariest Federal Reserve meeting is not the one with a shocking rate hike or an emergency cut. It is the one that looks calm while the pressure underneath is getting worse. When the people in charge stop moving, it does not always mean they are confident. Sometimes it means every move hurts. And when that happens, one market hears the truth long before the press conference begins. If you like catching the quiet signals before they turn into loud headlines, stay with me, because this is one of those moments that looks ordinary right before it stops being ordinary. Most people will watch a rate decision and think the story is simple. Rates go up, that is hawkish. Rates go down, that is dovish. Rates stay flat, nothing to see here, but that is how people think when they only look at the wheel and never look at the engine. A rate hold can be the most alarming signal of all when the central bank is not choosing patience, but surviving a trap. Think about what a central bank normally does. If inflation is too high, it raises rates to cool things down. Higher rates make borrowing more expensive, so people and businesses slow spending. If the economy gets weak, it cuts rates to make money cheaper and support growth. That is the textbook version, and textbooks are useful right up until real life starts breaking the rules. Now look at the kind of environment that breaks the rules. Energy prices start climbing, which pushes up the cost of shipping, food, power, and almost everything else. At the same time, growth begins to fade. Hiring softens, factories slow down, and consumers start pulling back. So the problem is no longer clean. It is inflation on one side, weakness on the other, and policymakers stuck in the middle. That middle is where the danger lives, because if the Fed cuts too soon, it risks feeding the very price pressures people are already angry about. If it raises too hard, it crushes a slowing economy and puts even more strain on a debt-loaded system. And if it does nothing, that is not a neutral act. It is a confession that the normal playbook no longer works. This is why the crowd keeps missing the real story. The public still treats central banks like powerful mechanics who can fix a machine with the right wrench. But late in a cycle, they start looking less like mechanics and more like drivers on black ice. They are still holding the wheel, yes, but that does not mean they control where the car goes next. And the road is full of hidden weight. Governments are carrying massive debt, old bonds come due, and that debt has to be rolled over at whatever interest rates exist now, not at the low rates from the easy money years. That means every month of high rates turns into a bigger interest bill, and that bigger interest bill has to be paid somehow. So policy is no longer just about inflation and jobs. It is also about how much pain the debt itself can tolerate. That matters more than people realize, because once debt gets large enough, even small rate moves stop being small. A quarter-point increase sounds boring on television, but across trillions of dollars, boring becomes expensive very fast. And when the cost of keeping rates high starts threatening the borrower at the center of the system, the central bank loses room without admitting it lost room. There is another layer almost nobody talks about in plain English. The Fed is supposed to project strength, stability, and control. That image matters because trust is part of how money works. But if the institution managing the currency looks boxed in, politically pressured, or financially strained on its own balance sheet, confidence starts leaking out of the room, not all at once, quietly first, then suddenly in price charts. That is why gold becomes so important in moments like this. Gold does not care about speeches. It does not need a policy memo, a smiling press conference, or a carefully chosen sentence. It responds to something more primitive, whether people still believe the guardians of money are free to act, or whether they are now performing strength while the math closes in. Gold moves when the market senses that the official story and the real condition are no longer the same. And here is the part that separates early movers from late ones. Gold usually does not explode the first time the pressure appears. In the beginning, the buying is quiet. Central banks diversify. Large funds rebalance. Long cycle investors start building positions while everybody else is distracted by stocks, politics, or the next inflation report. The first chapter of a major move rarely feels dramatic. It feels easy to ignore. Then comes the turn. The turn is not always a crash. Sometimes it is just a moment when the market realizes that people running the system are no longer choosing between good options. They are choosing between bad options and sometimes not even choosing at all. That is when a sleepy move can become a much faster one, because the question changes from will they manage this to how long can they keep pretending they still can. That change in question is everything. When the market believes the Fed still has freedom, it can argue about timing. Maybe cuts come later. Maybe inflation cools. Maybe growth reaccelerates. But when the market starts to suspect the Fed is cornered, price action changes character, assets tied to confidence and paper promises begin to wobble, and hard assets start behaving like escape valves. This is where most viewers get fooled by the headlines. News coverage loves the visible event, the statement, the dot plot, the press conference, the one-sentence traders react to for 30 seconds. But the deeper move is usually happening under that surface, inside the relationship between inflation, debt growth, and credibility. If you want analysis that listens for the strain under the words instead of the words alone, keep following, because the next layer explains why no change can be the loudest warning. Picture a house with 3 problems at once. The roof is leaking, the foundation is cracking, and the owner is already buried in loans. If he fixes the roof, the loan gets worse. If he saves money and ignores the roof, the house gets damaged. If he refinances at terrible terms, the monthly payment jumps. That is the kind of decision tree a late cycle central bank faces. Every fix deepens another wound. Now add politics to that house. Imagine the owner's family is shouting different instructions from the hallway. Every decision is public, and any move risks blame. That is what happens when monetary policy stops being a technical issue and becomes a public fight over prices, jobs, elections, and living costs. At that point, even the appearance of independence becomes fragile, and markets notice fragility faster than institutions admit it. The bond market notices first, because bonds live on trust and future payments. If investors start thinking inflation will stay sticky, or that more money creation is coming later, or that the government will drown in refinancing costs, they demand more yield to hold long-term debt. Yield is just the return investors ask for. When that demanded return rises, it is often a sign that confidence is getting more expensive. And when confidence gets more expensive, gold starts looking less like an old relic and more like insurance. The dollar can feel that pressure too. A currency stays strong not only because a country is powerful, but because the world believes its institutions can absorb stress better than everyone else. If that belief starts weakening even a little, the safe place premium begins to erode. That does not mean collapse tomorrow. It means the automatic trust that used to carry the system is no longer automatic. And then there is the part hiding in the dark corners of finance. Late in the cycle, the clean official numbers are only half the story. The other half sits in places the average person never sees. Private credit, private equity, leveraged businesses, funds holding assets at optimistic prices, lenders pretending time will solve what cash flow cannot. These are the dry leaves in the forest. They look harmless right up until a spark lands. When growth slows and rates stay higher than people expected, those hidden pockets start to matter. Weak companies have trouble refinancing. Borrowers miss payments. Funds delay exits. Banks become careful. Nobody rings a bell and says the stress has arrived. You only notice when more and more parts of the system stop working the way they used to. And by that point, the central bank is no longer managing a theory. It is managing damage. That is why the second chapter of a gold move can be so powerful. The first chapter is quiet accumulation. The second chapter begins when the wider market understands why the quiet buyers were early. This is the handoff from insiders who study structure to the broader public that reacts to visible consequences. And once that handoff begins, price is no longer moving on curiosity alone. It is moving on recognition. Recognition is stronger than fear in one important way. Fear can come and go with a headline. Recognition changes behavior. Once people understand that the system is trapped between inflation, debt, and economic weakness, they stop waiting for a perfect policy solution because they realize there may not be one. That is when gold stops looking like a side bet and starts looking like a response. If you have ever wondered why the biggest money often arrives before the explanation makes it to the evening news, this is why. Large investors do not wait for officials to say, yes, we are trapped. They watch the incentives, the constraints, and the language. They watch what institutions rename, what they avoid saying, what programs quietly appear, and which choices keep getting delayed. And from those clues, they build the map before the crowd notices the ground is moving. Retail investors usually enter later for a simple reason. They want confirmation that feels safe. They want a chart that already moved, an expert panel that already agrees, and a crisis big enough that the story feels obvious. But by the time a monetary trap feels obvious, the easiest part of the move is often already gone. That is true in gold, true in currencies, true in bonds, and true in every cycle where trust becomes the hidden price driver. This is also why related assets can wake up in stages. Gold often moves first because it is the cleanest signal. Silver can lag, then catch up faster. Mining stocks can stay ignored longer than they should, then reprice hard when the market finally believes higher metal prices are not temporary. Even cash itself changes character because people start asking not just how much cash they have, but what that cash will buy later. The order is never perfect, but the pattern often rhymes. First the signal, then the recognition, then the chase. Notice how different that is from the usual mainstream story. The mainstream story asks, what did the Fed do today? The deeper story asks, what can the Fed still do without breaking something bigger tomorrow? That second question is the one that matters when you are near the transition from a manageable slowdown to a credibility problem. And credibility problems are brutal because they feed on hesitation. If the Fed sounds tough but cannot tighten enough, markets see through it. If it sounds supportive but cannot ease without reigniting inflation, markets see through that too. The gap between what is said and what is possible becomes its own signal, and gold lives inside that gap. History never repeats exactly, but systems under pressure tend to rhyme in human ways. People deny first, then they debate, then they rationalize, then suddenly they act. In every era, the names change, the numbers change, the politics change, but the emotional sequence is familiar. Confidence softens, excuses multiply, trust thins out, and hard assets start speaking for the part of the market that no longer believes the script. That is why these moments feel confusing in real time and obvious in hindsight. What makes this period so dangerous is not one inflation report, one oil spike, or 1 week growth print. It is the combination. Prices stay uncomfortable, growth loses momentum, debt keeps pressing, and the institution in charge must look calm while standing in a narrowing hallway. When all of that happens together, a steady hand can actually be a frozen hand, and markets eventually figure out the difference. So here is a simple way to think about the road ahead. Chapter 1 is when smart money buys while the public still thinks the system is fine. Chapter 2 is when the public begins to understand the system is not fine, only managed. Chapter 3 is when people stop arguing about whether the problem is real and start scrambling for protection at the same time. The biggest gains rarely happen in the first chapter. The first chapter belongs to patience, the second belongs to recognition, the third belongs to urgency, and urgency is where moves become emotional, crowded, and difficult. That is where people finally buy the thing they mocked 6 months earlier. Not because they suddenly became experts, but because the cost of staying asleep got too high. If this kind of breakdown helps you see the machinery instead of just the headlines, stay close to this channel because the most expensive market lessons usually arrive disguised as boring policy updates. And the boring updates are often where the future first leaks into the present. That is especially true when the official message says stability. but the structure underneath says strain. Those are the moments worth paying attention to before everybody else decides they are important. Now bring this back to ordinary life, because this is not only about traders and macro charts. If the central bank is cornered, retirement accounts feel it, borrowing costs feel it, housing feels it, small businesses feel it, savings feel it too, because the question is no longer just how much interest cash earns today. The question is whether policy can protect purchasing power without breaking growth tomorrow. That is not a Wall Street question. That is a family budget question in a suit. And once you see the setup clearly, the whole press conference starts to look different. You stop listening for confidence and start listening for constraint. You stop asking whether the Fed sounds calm and start asking what they would do if conditions got worse from here. Because a central bank still in control has options. A trapped central bank has talking points. That is the hidden story of moments like this. Not that officials are weak, not that collapse is guaranteed, and not that every warning becomes a crisis tomorrow morning. The hidden story is that policy power has limits. And when those limits become visible, markets begin repricing far earlier than the public expects. Gold is not magic in that environment. It is simply one of the first places where fading trust shows up honestly. So if everyone around you is staring at the rate decision and saying nothing happened, look one layer deeper. Ask whether the hold was a sign of balance or a sign of paralysis. Ask whether inflation, debt, and slowing growth are giving policymakers room or quietly taking that room away. And ask why the asset with no earnings call, no central banker, and no need for permission keeps attracting attention when official certainty starts sounding thin. Because once the market understands that the trap is real, the move no longer waits for a formal announcement. It does not need a perfect sentence from the podium or a confession in plain English. It only needs enough people to realize that the institution steering the system is now working around constraints it cannot openly solve. That is usually when the second chapter begins, and it rarely sends an invitation before it starts. By the time the Fed sounds powerful again, the market may already be done paying you for noticing that it wasn't.